Welcome to a fireside chat on how trade and liquidity can help business manage global issues. My name's Edward Carr. I'm The Economist's deputy editor. And it seems today as if it's like one thing after another in the world. It's inflation, tightening of monetary policy, you have war, perhaps an incipient famine, you have growing tensions between China and the US affecting supply chains, you have COVID furthering the damage. It's one thing after another. And today, I'm very happy to be joined by two senior bankers from JP Morgan Chase, Laurie Shorts, who's the global head of liquidity and account solutions, and Stuart Roberts, who's the global head of trade and working capital. And together, we're going to talk about these issues and look at how finance is affected by them and how it can mitigate some of their worst effects. So welcome to both of you, Laurie and Stuart.
Thanks, Edward.
Now, Laurie, if I could just start with you. One of the things that strikes me as someone who writes about these events is just how much the world seems to have changed. So I wonder if I could just ask you to look back over your career and say whether, has it ever really been like this before, or does it feel to you as if we're in a kind of new world?
Gosh, yeah. There's a lot of change. That's definitely true. I mean, I think there's always elements of consistency that grounds us, right? So, changing monetary policy, rising interest rates, declining interest rates, quantitative easing followed by quantitative tightening. There's a predictability to a variety of factors, and I think we understand pretty broad stroke how different central banks will approach those situations, use their different monetary policy tools. But I think, having been through a few of these cycles in my career, to assume at any one point in time that you could predict exactly what flavor you will see in a different changing environment would be ill-fated. And for many of the reasons you've said, absolutely what's going on in the world right now does feel very different. But I think there's points of connection, and I know Stuart always talks about it extraordinarily eloquently, that can ground us back in maybe ways to expect and how to. We tend to take a general view that if you plan at your core how to manage your business in an efficient way to achieve visibility, control, and optimization, you'll prepare yourself. But indeed, these are different times, and I think there's quite a bit of volatility ahead of us.
Yeah, I mean, Stuart, one of the things that strikes me is how I don't know, one thing seems to lead to another. One bit of instability
Right.
seems to entail the next. And I know that you guys have been thinking about that and that sense that at some level, all these things are slightly interconnected.
Yeah, and I think obviously I'm a bit older than Laurie, so I go even further back. But I think that is the point, right? That we've had a series of issues in the past, and I started my banking career in the early 90s, right? We had Mexican peso crisis in 94. We had the UK being kicked out of the exchange rate mechanism, all the way through to an Asian crisis and Russian default in 98. Then we had the tech bust. I think one of the reasons why we now have the situation that we have now is because really, since Greenspan was Fed chair, the central bankers around the world started to move beyond just kind of monetary price stability as their key target, and they moved into trying to be almost Keynesian and using monetary policy to smooth out cycles. And you see each of those crises that we went through in the 90s and through into the 2000s. We saw massive central bank responses to those. Um, and I think COVID was like the straw that broke the camel's back, right? We saw central banks on steroids with a policy response. And all of that has built up over the last 30 years to a point now where we have an unprecedented amount of balance sheet at these central banks that has caused significant, I would say, asset price inflation over the last 30 years. We just haven't talked about it as much. And now we have, with significant geopolitical triggers, um, we have now actual core price inflation, food inflation, energy price inflation, which is being supercharged by over 30 years of central bank policy in response to earlier crises. So it is all interconnected. Um, and I think for us, for me, I don't want to get too pessimistic, but it feels like, we have the economy of the 70s mixed with the geopolitics of the 30s. And that to me is unprecedented in any of our careers.
So in that sense, you feel that um, we're in a sense we're paying for the good years that we had when each central bank intervention seemed to sort of save us from the pain, and we got so used to that we're going
Right.
to have to feel a lot of pain now.
Well, then now because the policy response just isn't available, right? Because the last thing you can do in high inflation is actually print more money and put a soothing, solving balm over the economy. You can't do that anymore. So now we actually do face an asset price and I would say overall demand break scenario. But in order to solve inflation, that we have to break demand, or the central banks will have to break demand. And we haven't had the central banks have to do that, really since the days of Volcker and, what we were talking about earlier, Margaret Thatcher, late 70s, early 80s. We haven't had that kind of experience. And so that's what I think we're facing now.
Now, I want to sort of drill down into the various areas where we're seeing pressure in a moment. Just before we do that, one
Mm-hmm.
last sort of broad question to both of you. Laurie, the one thing that you can say is that the volatility and uncertainty are going to be with us for a number of years now. Are there things, sort of general rules in the way companies manage their capital that just apply broadly to volatile times? And are there traps that they ought to avoid?
Uh, I mean, short answer, yes, absolutely. And from my vantage point, where we work with companies, is really about the effective utilization of their working capital. So I think tried and tested solutions to try to prepare yourself for a variety of different, economic, geopolitical, and otherwise factors is, self-funding at its finest, right? So managing your short-term cash, centralizing global treasury operations, creating this natural efficiency that you can within your own business to mobilize your liquidity versus necessarily what I think a lot of treasurers have more frequently relied on in past times is just short-term borrowing, because when you have massive liquidity in the system, as we saw post quantitative tightening, the cost of that liquidity is pretty cheap, all things considered. And I think that what I call the lazy treasurer behavior of not necessarily finding the time on the short term, do you understand where your receivables are coming from? Do you have a handle on your payments? Are you matching? Are you creating efficiencies? Are you looking at micro benefits from currency management? All those things become extremely expensive in a rising interest rate environment, in a reduced liquidity environment. And I mean, we got stats as recently as last week from a Fed perspective. You've already got reserves down $900 billion in USD. Bank deposits, the H8 is down net 100 billion. But if you actually normalized against the growth in assets and like loans and that sort of thing, it's closer to 600 billion. So liquidity will be removed out of the system for all the reasons Stuart said before. My general recommendation to all corporate treasurers is creating efficiency within your own self-funding control, visibility control optimization. That prepares you for a variety of different factors, because ultimately the short-term cash you are holding is a risk mitigant to run your business as well. And I think that we need to reamp up on those sorts of techniques in every environment. We saw a massive divergence of companies that had done that well versus hadn't going into the global pandemic.
And is this
If I could just
something?
add, sorry,
Yeah, please
just if
go
I could
ahead.
just add one point on that, I think we have over the last certainly 10 years with, where quantitative easing really picked up, um, people have just relied upon debt and equity within their balance sheet to that point of being lazy treasurers, lazy CFOs, right? And debt has been plentiful, cheap. No one's really worried about leverage ratios, and we've seen a steady climb in leverage ratios across companies around the world. Um, we've forgotten some of that efficiency play, right? Of what is, the non-debt working capital, right? Inventory sitting in balance sheets, right? We've been lazy. We said, okay, Our suppliers will carry the inventory. We push the pain down, right? Just in time manufacturing, just in time delivery. We've been kind of relatively lazy around receivables too, right? Just yes, ever longer receivables cycle times, right, that have been pushed out there. And so I think, yes, that ability just to go directly to the debt markets now is not going to be as attractive as it has been. And there is going to be a series of haves and have-nots, right? If you're in that triple B crossover into non-investment grade, it's going to get tougher. If you're already in the high yield, it's very tough. And clearly, the very highly rated investment grade names will take a lot longer to feel some of that pain. And then on the equity side, right, nobody wants to be going out and suppressing the equity prices right now when we've got a major de-risking going on within the equity markets. And so people are going to have to go and look at what's the cash on their balance sheets, and they're going to have to look at those uneconomic assets that are sitting on their balance sheet and do something about it. And that's where non-debt working capital, kind of the solutions that Laurie's team brings together in terms of really making your cash efficient, and the solutions that my team brings together in terms of monetizing those uneconomic assets are going to become absolutely to the fore.
And if you happen to be one of those treasurers who finds themselves with badly ranked debt, which was fine in the past and is now a real problem, what do you do? I mean, you're on the wrong side of some sort of threshold. What can you do?
Yeah, there's no other alternative other than belt tightening, right? You have to reduce your costs, and you have to de-lever, and you have to lower that leverage. If you are fortunate to be one of those high yield companies that is selling into companies that are better rated, then absolutely you should be looking at your receivables, your uneconomic assets. And that is a cheaper source of funding than issuing your own high yield debt. And you need to be looking at your inventory and figuring out if there is a new partnership, new ventures that you can strike up with your trading partners to figure out if they can hold the inventory off your balance sheet, again, reducing your debt, and even if that means paying a premium. That is something worth doing, because you need to now focus on moving up the ratings curve and getting out of that, dangerously high yield area. Because what you don't want to do, and I think this is something that we always stress, right, to people, is liquidity is never a problem, right, until it is a problem. And then at that point, it's the only problem, right? So it's like
Yes,
oxygen, right?
yes.
So what you don't want to be is in a position where you are in a place where all of a sudden you become liquidity starved because nobody wants to lend into you, because we have now a credit recession and people are trying to de-risk, or banks are trying to de-risk, institutional investors are trying to de-risk. And at that point, you have a liquidity problem. You definitely don't want to be there.
But Laurie, one
And
of
I
the
think,
difficult problems in this is that so many of the pressures that the world is putting on companies at the moment involve increasing the amount of capital tied up in the business. You have, what are the responses to supply chain problems? Well, it may be some vertical integration. It may be increasing your inventory so that you've got a more robust stock against fluctuations in supply. So how do that's another pressure on probably increasing the amount of capital tied up in the business just when you want to make things more efficient. How does one deal with that?
yeah, I mean, I think so. I mean, from my vantage point, it's like in how we help companies and we can see, it's like there's just sometimes call like marginal improvements that actually deliver far more than just the value at the margin, because actually in a lot of the treasurer and corporate treasury solutions we see is like where there is opportunity primed. You've got to like what inventory you need, all the various solutions which Stuart and team provide, they will deliver as they need to do. Where my team kind of comes in, and the prospect in the business is like, now you have your operations that need to run. And what we tend to find is there's a lot of decentralization through the mix. So what's happening is you're actually utilizing a lot of that working capital that you've generated pretty inefficiently. So if you've got pockets of cash across, if you've got each independent legal entity managing its own position, everyone's planning, or should be, right, planning for its highest level of need. If you can come in and you can actually centralize through regional treasury centers or even in-house banks, just some of the deployment and mobility of that cash, it can happen outside of requirements to inventory that you've mentioned and otherwise. But we actually see proven time and time again that just creating fungibility within your own company can reduce the amount of cash on hand by anywhere as upwards of 50%. So it becomes this efficiency on the use of working capital, which can help you either redeploy to pay down, debt that you shouldn't have been taking in the first place, or that will be more difficult to come by in the future. And these solutions are proven time and time again. You just have to take the effort and work to implement them.
One of the other things that happens in a tightening environment, especially when it's driven from the US, is obviously exchange rate volatility as well. So how do both of you advise clients on dealing with an increased environment of exchange rate fluctuations?
Yeah, I mean, I don't think there's
Yeah.
much you can do about it. Sorry, Laurie. Um,
Right.
I mean, I think for me, I think this also goes to the liquidity point, right? Yes, you can go out and you can go hedge and you can buy derivatives, right? And they're expensive. You can try to create natural hedges in terms of manufacturing, and we're seeing some of that. If you're sourcing from different parts of the world and you create that natural hedge. But I also worry that people aren't tying what the FX markets are telling us in terms of the credit markets and the funding markets, right? So, what is the dollar strength right now telling us? It is telling us that there is a flight of quality to the US dollar and to US dollar assets around the world, and it's leaving emerging markets, right? And it's going to create significant credit stress on those that are already, those countries, those companies that are already weakened by higher food and energy prices. The stress on the euro and the fact that the ECB is behind the rate curve, and certainly the Fed is behind the rate curve, but now the ECB is behind the Fed, right? And you can see that creating the stress on the euro and the kind of dislocation between the countries within Europe. And you saw that with Italian bond spreads last week. And then lastly, the fact that the Bank of Japan is trying to suppress yields because debt is so high in Japan is creating a significant free fall in the Japanese yen. And what does that mean in terms of Japanese banking sectors and their ability to continue to lend in dollars? So the actual volatility is one thing, and there's not really that much you can do. But what people should be looking at is, what are the FX markets telling us about the immediate future? And that's the piece that I often find that people aren't connecting the dots on. They see dollar strength, but they don't know kind of what that means as
Yes.
a second and third order effect.
Yes. Laurie, anything you'd
Yeah.
like to add to that?
No, I mean, I completely agree. I think there's no avoiding the volatility, and I think in addition to the hedges that can be taken, there's also synthetic hedging. And so, if I think about what is the antithesis to proper short-term cash management, and especially with a currency lens, it's accuracy of forecasting. So, where you can use kind of synthetic hedges through pooling solutions to give you kind of currency fungibility to maintain your operations while being a bit more strategic on an overall hedging strategy for your macro balance sheet currencies, that would be my recommendation day in and day out. But absolutely agree with Stuart's sentiments, is yes, to think about where the trajectory of travel is and how your businesses manage either naturally to hedge, synthetically to hedge, or to literally hedge.
Now we're almost coming to an end, and this has gone by very quickly. But I wonder if I could just finish by asking you if you see any silver lining in this. I mean, it's obviously a bad time, and people are worried. I guess you've already raised at least one, Laurie, with yours, thinking that actually you're doing things that you probably should have done earlier, and that will benefit the business, and you should keep going even when times are good. But do you see anything good coming out of all of this? First of all, you, Laurie, and then to you, Stuart.
Well, I'm the persistent optimist, so good to start with me. I mean, I think there was a huge divergence in, not necessarily the questions that were asked at the start of the pandemic, but the answers that people had to hand, specifically with a corporate treasury lens. So absolutely echoing what Stuart said, right? Where is my liquidity? How fast can I get access to it? And how much do I have? And I have to believe that the silver lining is those questions around the importance and access to liquidity are consistent. And so we know that where the opportunity is to, with your overall working capital solution, make sure that you are in a position to be able to answer those questions and access that cash as quick as possible and in an efficient way.
And Stuart?
Yeah, I mean, I guess if there isn't a significant rise in unemployment, I would say that an asset price correction coupled with some wage price increases might well do might be very good for particularly younger people in terms of being able to get on an asset ladder, which has been not gradually, accelerating away from them from the last 30 years. And so one of the things I do think is a potential is if there is an asset price correction, it should create more equal opportunities as long as wage prices rise and there isn't, mass unemployment.
Yes. Well, it strikes me that sometimes some of these things are inevitable. You sort of have to go through them, and the art is in going through them as well and sensibly as possible. And that you've both explained really clearly today how managing your capital is an essential part of that. So Laurie Schwartz and Stuart Roberts, I'd like to thank you both very much for this fireside chat.
Thank you, Edward.
Great. Thank you.